And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, proud sponsor of the ABSA Africa Financial Markets Index 2025. Good evening. Welcome to the program. I'm Stephen Grootes, 11 minutes after 6. Plenty of corporate news today, lots of updates. We'll get into it all in just a moment. We'll start with the founder and executive director at WeBuyCars, Faan van der Walt. I don't think they were expecting what happened today with their share price. Earnings update, not too bad, it would seem. And suddenly their price, well, I have to use the analogy, crashed. We'll find out if they were expecting that in just a moment. The Port of Gauteng saying the Transport Department needs a reality check over the way in which it wants to manage that freight corridor from Durban to Gauteng. There's a lot going on there. And then also, of course, Rhys Summerton, he's the joint CEO at Ayoko. You may remember them as EOH. They've had a strong update. They're back into profit. Also, the CEO of Old Mutual today, Jurie Strydom, they had a capital markets day, but also confirmed they're buying 10X. And then also before 7 o'clock, Peter Machlape is the managing director at Medtronic. He's written a book, Winning in Africa. You know his two co-authors, by the way, Shamil Jusub and Professor Adrian Saville. Looking forward to that conversation before 8 o'clock. I don't know if you've been looking, I kind of have this idea that buying a new car, as in a brand new car, is something maybe most people do once in their life. I think most people, it's not something that happens very often. But I did wonder if maybe some cars now, some of the Chinese, Indian brands, are so much cheaper than you would expect that actually you're buying a new car rather than an older second-hand car. Your views on that, 011-883-0702, 021-446-0567, and voice notes, of course, on 072-702-1702.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV Channel 856.
Well, an intriguing story playing out around WeBuyCars today. It put out a statement saying it expected headline earnings for the 6 months to the end of September to be up by between 12 and 17%. As trading started, as shares dropped dramatically, it seems investors maybe were expecting stronger growth in the second half. They ended the day down around 13.5%. Faan van der Walt is the founder and executive director at WeBuyCars. Faan, good evening. Were you expecting such a strong negative reaction to your update this morning?
Good evening, Stephen, and thank you for having me. It's always interesting to see how the market reacts to performance statements, and today was indeed an interesting one. We put out a trading statement saying that we expect our core headline earnings to sit between 917 million rand and 958 million rand, which is far better than what we did last year, somewhere between 12 and 17% better. But our shareholders do have very high expectations, so I guess this was a reaction to that. From our side, we feel that our first half was fantastic, and the second half of the year was somewhat subdued. Softer than expected, it's all to do with consumer constraints. You know, we saw the finance approval rates drop as low as 40%, 41% down from 46% at the beginning of the year. So there's definitely a slowdown in credit and a wait-and-see attitude. But you nailed it when you also spoke about the Chinese cars, entering the market and also stealing market share for the used car industry, which does have an impact, unfortunately. But it's also a very positive signal because those cars will then trickle into the car park and form part of the car pool, which we need, in the used vehicle industry. So looking at new vehicle sales, we've seen a very, very buoyant period so far this year, and we expect that to continue. So that's great for new vehicle sales. It's all happening in the mid-price ranges. You would definitely not see the upper end in the luxurious car market gaining traction at the moment because people are just far too constrained. But this is definitely playing into that niche where someone considered buying a second-hand vehicle for around 400,000 rand, but now decide to buy a brand new Chinese vehicle, for instance, which offers great value for money. So there is a definite shift in the market, and we've seen this many times before. We've seen the ebbs and flows and the demand come and go from time to time, and a bit of a slowdown, and then again an acceleration in demand for our services.
Well, I mean, you say all of that, Faan, but Chinese cars are not going to get more expensive. I don't know if you're aware of just how much capacity there is in China. They had to shut down half of their electric car capacity just for it to make sense anymore. I do wonder if that maybe does actually have a big impact on your operating model over the longer term.
No, I think it's definitely a positive thing. We've seen this,
but not for you.
With the entrance. No, absolutely. We see it as absolutely positive because we're already trading cars very successfully. Chinese brands coming into the market. There's a huge demand, even second-hand, for these vehicles. So what's interesting is what we've seen is people purchasing these cars do not keep them as long as the traditional VW or Audi buyer out there. So it will be very interesting to watch the dynamics over time, but it's definitely not something that we are concerned about. We want to be involved in every second-hand deal, and over the lifespan of a used car, it will change hands a number of times. Our data shows that, when someone buys a new vehicle, they keep it for around 5 years approximately. Some brands shorter and some brands a little bit longer. But once it's used, they trade them around every 3 to 3.5 years. And that's where we come into play. We want to do each and every transaction in the used car space. Currently, when we look at the used car market, there's around 150 to 160,000 vehicles being traded every month. So our market share is still very, very small. So there's lots of space for growth, and there's a highly fragmented market out there.
So sure. I mean, this is the other point, though, isn't it, Faan, that your company 5-10 years ago, very few people would have heard from you. You've grown in the public mind very quickly. You've got your supermarkets, your car supermarkets all over the place. Isn't this just the point where growth had to slow eventually? And isn't this just a natural thing? And that's fine. But it does mean that investors can't expect the growth they've seen.
Well, we're very ambitious, Stephen. We feel that, yes, we're now sitting in double digits market share. But when you look at big companies, let's look at a Dis-Chem or a Capitec or all those companies, they've grown way beyond that. So we believe that the next phase of growth will depend on us and how much effort we put into that. And for that reason, over the last year, we've invested heavily in new infrastructure. We are currently building mega warehouses both in Gauteng and in Cape Town, close to the size of the dome. So we're very ambitious to reach our growth target of 23,000 units by 2028. But we've also invested in people, training systems, AI systems, and vehicle evaluation systems. We've just launched a software system called Inspectify that really simplifies vehicle inspections and condition reports so that the average consumer can understand it, and it's in simple, normal language.
Faan van der Walt, we'll have to leave it there. Thank you very much indeed. Founder and Executive Director at WeBuyCars. Your views, please. 19 minutes after 6.
702. Stephen is on X.
At Stephen Grootes.
A pretty positive reaction to the Transport Department's proposals over the weekend for the private sector to play a much bigger role in our railway system, including requests for information about rail links between cities like Durban, Joburg and Messina. But the Port of Gauteng has a very different view. The port developers, Francois Norkier. Francois, good evening. You believe the Transport Department needs a reality check. Why do you say that?
Yes, let me just go back again. The request for information brought out very good points, 5 basic points that they brought out. They need more digitalization, a massive car terminal, a massive container terminal, better lines, and sustainability. 100% correct. But this line has got a problem. It's a systematic problem. It's only 550 kilometers from the port of Gauteng to the port in Durban. Rail normally works over a longer distance. That is the road. The railway line was built in Natal. It went from town to town and then to Volksrus and then to Port of Gauteng. That is 690 kilometers. So it's got 25% further to travel than the road to travel. That's part of the problem it's got. It's not easy line to run. A train can compete with a truck to Cape Town and Kaberga, but it's very easy for the trucks to compete to Durban, between Durban and Gauteng. The N3 toll concession, and Old Mutual is on the show just now. Old Mutual owns 39% of it. Done a fantastic job. That highway runs so nicely, it's straightened, it's shortened, and that is part of the problem. Then there's also unscrupulous operators that's on that route. People that don't necessarily maintain their trucks, the people that don't belong to the bargaining council, and that makes the pricing on trucking very competitive. Now, this railway line between Durban and Gauteng loses about 2.3 billion rand a year. It's one of the biggest loss leaders in Transnet, and of Transnet's debt of 144 billion, this line since 2012 has contributed about 24 billion to that loss. So the private sector will improve it, but the private sector is not that good. In 2012, they talked road to rail. Jack van der Merwe, which is now the minister's advisor, he was the head of the committee that wrote the Gauteng. Then he was the head of the committee that wrote the Gauteng 25-year transport plan in 2013. You had to see the projections that they had for containers going to container terminals in Gauteng. Over 1 million a year at the moment. It's only standing at 200 or 300,000. So Jack van der Merwe has got a history of overestimating rail's ability. And what I'm just saying is, please, we need this rail to work. We cannot let Jack van der Merwe make the same mistakes he made in 2012 and 2013, overestimating it.
Okay, Francois, I'm sorry to interrupt you. I mean, it seems like you and he clearly have a long history together in some way. Never mind. There are ways that you could change that. You could increase tolls on railway, on the trucks. You could easily do that. You could also, if you had a really proper, reliable, very regular service between Durban and Gauteng. Not everything needs to be done in a rush. I think not everything needs to be moved from one place to another in a rush. I think you might find that actually people would appreciate the reliability, and wouldn't that be a big advantage for a railway network if it was run properly in the first place?
Are you talking about passenger, or are you talking
freight?
About...
No, I'm talking about freight, yeah.
Right. The moment the line has got 2 Rand 50 cent expense for 1 Rand income. So it's already slow and whatever. I was a private sector guy, and that's why we issued the white paper on this. And we're saying either we must let the road run and the toll fees will come down in 2029 because the cost of capital has come down when it gets renegotiated, or the government must subsidize this railway line, or we must get the current road tolls to subsidize the rail. And that's been overlooked. It needs help. It's not going to come right by itself. It's already slow. It takes 24 hours for a train from Durban to Gauteng, 21 hours to the Port of Gauteng, and then 3 hours to City Deep. It takes a week to turn around in City Deep, and where a truck takes 8 or 9 hours. But who's going to sort out the 2.3 billion rand debt or loss a year? It's not the private sector is not going to participate in a loss-making entity. There needs to be some subsidy or some cost sharing, and we're getting an economic rail regulator that will need to they can determine the fees. And our suggestion is that the toll concession, when it comes to an end in 2029, your next guest won't be happy. Old Mutual is a big shareholder in that. That must revert back to SANRAL. And the difference between today's tolls and what the tolls really needs to be must be sent over to TRIM, Transnet Rail Infrastructure Manager, to subsidize the rail. Without a subsidy, the rail between Durban and Gauteng is not going to work. Rail is 690 kilometers and the road is 550 kilometers.
Francois Nokia, thanks very much indeed. The port developer at the Port of Gauteng. Okay, a contrary view there. I don't know how you feel about that. Could rail actually do what road does now? The other issue, of course, is what's happening to the N3, the sheer amount of maintenance that it needs. And I'm sure, like me, you have driven from Durban to Joburg. And as you get to certain times of the day and you trudge through Pietermaritzburg past truck after truck after truck, Anything that would fix that. 011 883 0702 021 446 0567. Also your voice notes on 072 702 1702. 26 minutes now after 6.
702. Stephen is on the Money Show.
6 to 8 p.m.
The IT group IOCO confirming today it's increased its EBITDA by 68%, swinging back into profit. They've been through a big restructuring process. Rhys Summerton is the joint CEO at IOCO. Rhys, good evening. I do appreciate the time. You've made major changes. You've sold some parts of your business. You're moving into a profit now. Are you seeing the benefits of the changes you've made?
Oh, most definitely. We haven't sold any assets this last year. So these numbers and 354 million of free cash flow that was generated all came from the operating businesses, which is the first time we've done that for 3 or 4 years. And we're in a position of strength, strong balance sheet. We can now move ahead with the capital allocation part of our strategy, buying shares back and looking for some exciting acquisitions.
You said earlier today you actually had made more progress more quickly than you had planned. What allowed you to move so quickly? I mean, sometimes things just go right. I get that, but not very often.
Yeah, turnarounds are difficult, and I don't think there was a more challenging turnaround than IOCO. I think the first thing we did is we brought back Shona as the CFO, which was really one of the big drivers of the turnaround. And then the second thing is last year we kind of said to the key executives, we want you to run your own businesses in a very decentralized way. And so that kicked off at the start of this year, 2025. And I'd say the business unit chief executives kind of all embraced this decentralization or radical autonomy idea. And they have delivered some very good results. So when you cut this bloated or head office, and then you allow the operating businesses to come through and deliver, you get a really good result out of it.
You want to buy some new businesses, I understand. Do you have a few targets in mind already?
Yeah, so we have a process in place. So I think if you think about IOCO in the years ahead, it's going to be a serial acquirer of businesses. We want to get to the point where IOCO takes advantage of strong balance sheet, its assessed tax losses, to be able to buy niche players, and what that'll do is complement the existing platform. Then you add on parts of the business that are missing. So IOCO touches 4,000 clients in South Africa. So it touches virtually every major company in South Africa somewhere. But what you want to do is get a bigger share of that wallet. So you want to gain some market share. And we think you need some new technologies. I mean, technology moves so quickly that you've got to make acquisitions to remain relevant and on the front foot.
Rhys Summerton, really appreciate the time. Thank you. Joint CEO at IOCO.
The Money Show.
The Markets.
Kwena Maloko is with equity research sales at Absa CIB. Kwena, good evening. WeBuyCars. You heard the CEO there. I asked, were you expecting such a reaction? I felt probably not.
Yeah, it's difficult to expect a 13% on any day, but I think you were quite right there in that when you go from giving the market sort of 20 years of earnings growth consistently, even a small miss, like he alluded to now, can get punished quite aggressively. But I think ultimately, at the end of the day, this was the market trying to find where the new base is, just given the outlook, like you said, on the prices of used cars, given what's happening in the new vehicle sales and with the pricing on the Chinese side.
Old Mutual, they're spending money on 10X. They had Capital Markets Day today. What stood out from their Capital Markets Day for you?
Yeah, for sure. I think 10X was the thing that sort of grabbed the headlines. I mean, it probably is strategically sound, right? So gives Old Mutual access to 10X is sort of 60,000 clients, AUM of about 70 billion. But I think more importantly, it sort of fits into their broader wealth business strategy. And I think that's part of what investors were looking for. But for me, it was the bank. Everyone's been looking at that as well. And they gave us some numbers. Currently 150 clients. They're signing up 5,000 people a day. And they gave us the year where they believe bank will be break even. So that is FY28. And that will be a feat if they can achieve it.
There's another bank that did it a little earlier than its target, so there will be a story there. MTN was up strongly on the day. What was driving that?
Yeah, that's probably on the back of some really good results we saw from Airtel Africa, right? So we're talking 20% revenue growth, 30% profit growth, and a lot of that is a recovery in some of the regions that they are in with MTN. So, for example, we've seen very strong currency appreciation in Nigeria, in East Africa, and all these other regions. So I think what the market is doing is anticipating that tonight when we get results from MTN Ghana and on Friday when we get results from MTN Nigeria, you'll probably see similar type themes. Very strong growth, very strong margins, very strong profits, and then just getting a little bit ahead of that. I mean, group earnings at in November sometime will probably just give you more color on South Africa, but that's, not as exciting as the rest of Africa regions for MTN.
Kwena Maloko, thanks so much from Equity Research Sales at ABSA CIB.
WhatsApp Stephen
on 072
702
1702.
Well, plenty of voice notes coming through tonight. You heard the conversation with the CEO of WeBuyCars. Part of it is around whether you would buy now a second-hand car, or if you could, you would prefer to buy a new, cheaper than you used to expect, Chinese car.
Hi, Stephen. For me, I mean, you need to look at the results, balance that with the outlook of the, second-hand car market. And I think, new car sales have seen better days. I know they're slightly improving, particularly with the entrance of the Chinese car makers. But for me, I think for eBuy, it's all about, what's the sentiment looking like around disposable income in the short to medium term. And then what is also the competition doing? Seeing in the market new alternative funding models to vehicle purchase, or rental. So where does eBuy fall in that? As diversification of car, funding models, starts to proliferate in South Africa. Thanks.
Stephen, Rob from Josie here. Faan van der Walt, little bit economical with the truth. I think the reason why the shares are dipping is because people are not that dumb. I think they're wisening up to the fact that, you can't complain about the after-sale service at WeBuyCars because there isn't any. In fact, it's really quite shocking. So, I think buy a car from WeBuyCars at your own peril, whether it's used. Well, most of them are used, right?
There's a story there about a used car salesman. That's all I'm going to say, and I don't mean to be rude. They've built a very successful business. But I do hear you on that. 19 minutes now to 7.
702 with Stephen Grootes.
Email him on stephen@702.co.za.
13 minutes to 8 the time. Watching Castle Matale take questions in the next little while. He's been taking questions through most of the day from MPs in Parliament as part of the ad hoc commission of inquiry into claims of interference and corruption in the SAPS. And one of the things that came out is that it turns out a year after he had been appointed Deputy Minister of Police, he still didn't have any official duties assigned to him. And I've got 2 big points to make about this. The first is obvious. What are deputy ministers for? We still have this problem. And deputy ministers, let's make no bones about this, are expensive for you and me. They get 2 properties, places to live in, one in Gauteng, one in Cape Town. By the way, each of those places gets a backup generator and the diesel's paid for by, you guessed it, look in the mirror. So firstly, they're expensive. And the second is, Castle Matale, as Polly van Wyk reminded us, was the person who, it seems, was very much involved with Julius Malema in Limpopo and the On Point scandal when he was the Premier of Limpopo. And again, never been a satisfactory explanation from the NPA as to why Malema, and presumably at the end of it, Castle Matale, would not be investigated for that, would not be prosecuted for that. He's now the Deputy Minister of Police. And I still don't know what a Deputy Minister does. I have to say, I have not seen anywhere in all of the conversations around this any support for Castle Matale. Could be wrong. Please prove me wrong. On 011 8830 702 021 446 0567 and voice notes tonight on 072 702 1702.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Well, you will have heard the phrase Africa is the continent of the future more than once on this program, and at the same time, some of our companies that have gone to other parts of our continent have had mixed success. Think of MTN in Nigeria as a good example of how complicated things can be. Someone who's been looking at this and someone who's actually spent a lot of time doing business on our continent is Peter Mokhlape, managing director at Medtronic, has written a book called Winning in Africa. His two co-authors are very interesting in their own right. One's the Vodacom CEO, Shamil Yusuf, and the other is Adrian Saville. You know Professor Saville well. Peter, good evening. You've written this book based on your experience, on the experience of your co-authors. What for you is the major secret to success on the rest of our continent? It seems to involve not just profit, but purpose.
Yes, Stephen, thank you very much for inviting me to your show, and good evening to the listeners. Yes, the Winning in Africa, your next 8 moves, was written out of my experience of traveling over 40 countries on the continent, doing business, setting up business, facing the reality of what works, what doesn't work, things to look out for. I mean, one of those examples where me and Shamil Yusuf crossed was when I was managing the business through Africa, including the Mediterranean islands. Egypt's currency was tanking. Egyptian pounds depreciated in 1 year from 15 pounds to a dollar to 30 pounds to a dollar to 50 pounds to a dollar. So some of the kind of fires that we faced on the road, trying to do business in an environment where currency is just becoming porridge.
It's interesting because we're actually beginning to see that in our country too. The private sector, to be successful, is getting more involved in things that the state used to do or should be doing. And maybe some of them are beginning to marry those ideas of purpose and profit.
Yeah, and this is a very good example on the continent. I mean, gone are the days where, if you're producing steel or medicine, you just do that. You have to obviously look at the unmet needs of the communities where you're working to make sure that the whole ecosystem is strong. For example, in our case, working in a healthcare environment, providing diagnostic tools or medical devices, at times we had to work with healthcare workers to strengthen laboratories, making sure that the whole process of testing, even bringing in technology that is more relevant to the market. For instance, handheld devices or battery-operated devices that can work in places where there's no electricity, under a tree, a clinic that is not really very well equipped. In the case of Vodacom, Shamil talks about them working in Tanzania, having to provide the healthcare through women healthcare program that they had, which is not the responsibility of a telco. And I call it a shared value creation where you're trying to solve societal problems, while you're making profit and strengthening the communities that are your customers.
I think some people, particularly people who don't know our continent, would say, why should a telecoms company get involved in that sort of thing?
It's for sustainability. If you win, the community wins, and you create a very strong, sustainable customer base for you. So you look at a kind of a bigger picture as opposed to a narrow picture for just specializing in telco.
Peter Mokhlape, thanks very much indeed. Managing Director at Medtronic. The book's called Winning in Africa. He wrote it along with Shamil Yusuf, the CEO at Vodacom, and Professor Adrian Saville.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud sponsor of the Absa Africa Financial Markets Index 2025.
6 minutes now to 7 the time. Well, Old Mutual are confirming today it's spending 2.2 billion rand to take controlling share of 10X Investments. 10X provides retirement and savings products using passive investments. They also had a capital markets day today. Jurie Strydom is the CEO of the Old Mutual Group. Jurie, good evening. I really appreciate the time. What is it about 10X that makes it so attractive to you at this moment?
Hi, Stephen. Good evening. Good to be with you. So 10X, if you look at the areas of growth in the markets, passives, ETFs, and particularly in the sort of direct and digital space, then 10X really is one of the companies that's emerged very strong in the last few years. So, it's taken in, I think, something like a third of the net inflows into that part of the market over the last few years. So we're excited to be bringing those capabilities and that team into the group.
You clearly believe there's a lot of growth still, a lot of room for growth here.
Yeah, our projections show that section of the market's going to grow, compounded over the next 10 years by at least 15%. So we think there's lots of headroom there.
One of the things 10X did, as I understand it, was that they really got very competitive around fees. Do you think there's scope for fees for what will now be your customers to go down further? I mean, obviously, with scale, with digitization, all of that sort of thing, you would think there might be a bit more space for fees to go down further.
These are products that offer great value to customers, and I think with scale, what we bring as Old Mutual is obviously we bring kind of asset gathering capability, distribution capability, which will enable that business to scale further.
As a group now, as Old Mutual, the group, you actually, as I understand it, want to cut your costs by 2.5 billion rand. Where would those savings come from, Jurie? I mean, that's even at your level, that's quite a lot of money.
Yeah, so Steve, that represents about 10% of our expense base, our operating expense base of last year. Obviously we'll be looking at all areas of the business and opportunities to, over this year, 2026 and 2027, to look at where the opportunities to cut costs. But we think it's important, when you're serving the South African markets, and markets across the continent, you've got to be competitive in your cost to serve, and this is part of it.
Amazon said today they're cutting 14,000 jobs just through using AI. I mean, I presume some of these savings would come through AI and things like that?
Yeah, so over time, AI is all companies, I think, are looking at AI, and one of the big use cases of AI is automation, of course, across different industries and different parts of the value chain. So that'll be part of it. But it's also just, looking at other sources of efficiencies as well, and just looking at how we do things.
You've set yourself as Old Mutual medium-term targets of returns of around 15% dividend growth of between 6 to 9%. How confident are you'll be able to hit those targets in the medium term?
Well, so there are targets that are ambitious in the sense that in the number of areas, like return on net asset value, as you mentioned. We've got work to do to get ourselves into range. We sort of see it in two phases. There's a value unlock phase, which is really, getting ourselves consistently into those, into those metrics, which, the cost is one part of it. But there are other pieces as well in terms of improving the basic competitiveness of our businesses and executing better. And then we've got to put the runs on the board.
Obviously a lot of attention on your bank. My understanding is you wanted to break even in around 2028. You're taking in what seems to be a large number of customers on a regular basis. What makes you think, what makes you confident 2028 will be the moment it can break even?
So look, you do your projections based on the number of customers that you need and what's revenue per customer, the activity of those customers. So there's a whole lot that goes into that. What's super encouraging for us is the scale at which we're able to onboard customers at this stage. We've gone live with our bank in the last few weeks, and we've scaled up to, being able to onboard 5,000 customers a day at this point. So that's super encouraging. What works in our favor is the reach that we have. So Old Mutual's got 350 branches across the country. We've got already a very significant lending operation, a 15.5 billion lending book. And of course, we've ultimately also got a very strong advisor network. So this is what we're encouraged by, and I think it's a good start for us. And as we build the bank further, we'll look to see how we can put those numbers on the board.
What people really want from a bank is an app that's easier and simpler to use than everyone else's app, and the app is the main point of contact.
Yep. The app, yes. I think I have an Old Mutual bank account. I bank with Old Mutual. I've got the app. I think if listeners go in and try it, I think you'll see that it is a good piece of technology. It works well. But I also think that the customers are looking, and our research tells us that customers are also looking for a place where they can talk to someone. And, our branches do provide that footprint as well, where you can talk to a human being, you can get advice, not only just on your bank, but also on your insurance policies.
Jurie Strydom, thanks so much. CEO at the Old Mutual Group. Do appreciate the time. With the Money Show, 7 o'clock.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud sponsor of the Absa Africa Financial Markets Index 2025.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
Good evening, 9 minutes after 7 the time. Plenty coming up in the next little while. We'll focus a little bit more on our continent as I am Tlanga, the chief economist at Rand Merchant Bank. He's put out the Where to Invest in Africa report. There is, I think, an important story there about just doing it for yourself. If you look at who are the top countries in which to invest in Africa, Rotendo Ndingwe from Tribe Africa Advisory, he'll particularly be looking at the US and Ethiopia. And then don't forget Warren Ingram as well tonight. He is looking at the real cost of buy now, pay later. By the way, there are one or two moments where I think he's not going to mind too much if you buy now and pay later. I'll let him speak for himself from 7:30. Good to hear from you as well on 011 883 0702 021 446 0567 and voice notes tonight on 072 702 1702. We've been particularly talking about cars after that conversation with WeBuyCars, and particularly when you consider their share price was down so strongly today, that did lead to a conversation about whether to buy sort of cheaper, Chinese, and new, rather than older, slightly more expensive, and pre-owned. Certainly some voice notes coming through on that tonight.
For me, it's definitely the Chinese cars. I've been driving one for 3 years now. I've got no regrets. I'm happy. I'm actually getting another one of a similar brand. And also, I'm not going to mention any brands. If you buy this brand, if it's a new car altogether, you get warranty and whatnot till million mileage, so million kilometers. So it's those kind of things where you're like, I'd rather have this as opposed to getting a second-hand car where it's going to give me issues and whatnot, and they're going to tell me that it was a rip-off, yada 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 yada. So I'd rather be at peace, with a brand that's not that popular, but I'm at peace and I'm enjoying the drive and all of that.
That's such a good point, actually, that peace of mind with the new, with the sort of mileage guarantee. Obviously, it won't be for the whole car. I mean, I doubt they're going to give you new headlights in under 1 million Ks or whatever it is. I remember years ago, I think it might have been Samsung. I mean, I'm talking 15 years ago. They're up against Sony. I mean, Sony, you forget, used to just dominate the market in everything. And Samsung would come out with every video recorder, remember them? CD player, remember them? It's just a 2-year guarantee, a bog standard, everything with a 2-year guarantee. I think they walked off the shelves because of that. Thanks very much indeed for that voice note.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app
and DSTV channel 856.
On the next Money Show, Nikki Bush joins us as your shapeshifter, one of the most sought-after speakers, an author, a media personality, had a very interesting career path. Graham Codrington, the futurist and partner at Tomorrow Today, the latest from the world of business unusual, and your consumer ninja, Wendy Nola, ready to fight for your consumer rights. All of that and the top business news of the day.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
A reminder, I thought today, of how important it is to get your own house in order if you want investment. So if you think of everything that's shaped the world around Africa over the last year, the Trump administration, we've seen what's been happening in the Sahel, things like that. RMB saying today that the top 5 places to invest in Africa have not changed since their last report last year. The Seychelles and Mauritius still number 1 and 2, followed by Egypt, South Africa, and then Morocco. Azai Mhlanga is the chief economist at Rand Merchant Bank. Azai, good evening. What makes the Seychelles and Mauritius so appealing? I mean, they're pretty small markets, but second year in a row, both at the top?
Indeed, Stephen, it's how we construct the index. It has about 4 pillars that would include economic structure and performance. We have market accessibility and innovation. We have economic stability and investment climate. And then the last one, we have the social and human capital development. So if you think about Seychelles and Mauritius, they are very small economies, which means they would rank very low on the economic potential and performance, and that constitutes about 35% of the index. But on all the other three, they are well positioned, they are very competitive, they rank very highly, and that is 75, almost like 65% of the index, which means they would rank above all the other countries.
We come just after Egypt. Now, Egypt's got a big population, a high level of industrial development. What pips them? I mean, why are they slightly better than us?
You have seen significant investment flows coming into Egypt from the Middle East, which has helped from an FDI perspective, and therefore that improves their economic performance and potential. They also have a large population, which means from a size of the economy perspective, they do very well. They generally have, a good market structure, well regulated, which means the institutions that underpin that economy, they're also well regarded. They had a bit of a currency devaluation at some point, but that was not big enough to derail their ranking. But it is, to a large extent, economic growth. They are better. The size of the economy is also better from a population perspective, even though if you look from a GDP perspective, South Africa is bigger than Egypt.
Are you seeing major changes in the investment climate? I mean, we've had obviously a few elections this year, big changes from the US, which has shaped things. I think China's trying to take advantage of that to an extent. Are you seeing the impact of all of those global shifts?
Yeah, we have seen a big impact. What we were surprised by, first, Nigeria. It declined by 9 points this year from being ranked number 9 in last year's edition to being ranked 18th this year. There are two major moves that resulted in that. The first one is the collapsing of the two parallel markets, the black market and the official market, into just one market, and also the devaluation of the Naira, which meant that when you measure the Nigerian economy in dollar terms, it's a significantly smaller economy because of the currency devaluation. The second aspect is the restatement or the revision of economic statistics, which is not unusual. It happens in every economy once every 5 years, reassess the economy to see if there are sectors that are much bigger or some that have declined. You would know the gig economy in Nigeria is quite a booming industry. So from time to time, alongside international benchmarks, you reassess the size of the economy. So that was done while we were doing the report. So we had to update, the structure of the economy, and they found that the economy is some 30% larger than what it was. But still, the impact of the currency devaluation was much larger, which is why Nigeria ended up being ranked lower. So they are declining for the right reasons, because they're doing the right policies to actually make the economy more resilient. So which is an important aspect when you look at the rankings. You must take the context into account. It's almost like if you are sick, you need to take the medication, but while you're taking it, you might be dizzy. That is the analogy that I can give to you. So when a person look at your health status, they must take into account why you are experiencing what you are seeing. If you are doing the right things to make you a more resilient economy, it is positive despite the decline in the ranking.
I made the point at the start of this, Isaiah, that, I was talking earlier, in fact, that people will use this phrase, Africa is the continent of the future, and what they base that on, really, I suppose, is that our population is growing. Places like China and India are declining or about to decline. Do you see any investment that reflects that idea that Africa is the future, or do you think it's still a political slogan more than anything?
It's not a slogan. I think when you look at all the continents, they have their periods where they become the flavor for the right reasons. If you think about the green industrial revolution that we're talking about, you need all the critical minerals that enable the global economy to decarbonize. Africa has a big role to play in that perspective. If you think about the population size, by 2050, Africa would have 2.5 billion people. That's a quarter of the global population, which means, there's a significant market. If you think about the, average age or median age of Africa relative to other continents, the median age in Africa is 19 years old, which means strong labor market that you have is combined with development of skills that we can supply to the rest of the world. I mean, Asia has an aging population, Europe has an aging population, the US has an aging population, and they would need a strong workforce to continue to supply the products which they consume. And then you look at, agricultural potential. Africa has arable land, which is quite important to feed the 8 billion people that will be then in 2050. So Africa has a big role to play. We just need to be able to create the right institutional frameworks that make sure that investors feel comfortable. There's predictability in terms of, when they invest their money, they will be able to take their money out when they realize the returns in their investments. What we also did this year in the report on the back of the trade tariffs that we see from the U.S. is to look at the export potential of the African countries, but also to provide a currency model that gives you a sense of which currencies are overvalued, which ones are undervalued, and which ones are susceptible to policy risks, so that when investors make investments in these countries, they are aware of the risks which they're taking.
Zara Mplanga, thanks so much. Really appreciate it. Chief Economist at Rand Merchant Bank and one of the people behind that report, the RMB Invest in Africa report. 19 minutes after 7.
The Money Show, Africa Business Focus.
Dr. Rotendo Ndingwi, the founding director of Tribe Africa Advisory, joins us. Now, Rotendo, how's it? The US seems to be getting closer to Ethiopia. I mean, it's fascinating to watch this. I mean, in a way, I think those leaders might quite like each other.
No, it's all about money and what you gain from it. But it's true. I mean, Ethiopia and the US has just confirmed a $10 billion investment in a new airport. So remember that current airport is Bole, but there's another airport called Bishoftu Airport, which is just out of town. I've been to it, but it's a $10 billion investment. So that's an exciting thing.
That's a lot of money on one airport. $10 billion.
It's $10 billion. But then you ask yourself why? Because Ethiopia doesn't have minerals. It's not like Angola with the whole Obito corridor thing. But you must remember strategically, you've got that big military site, Djibouti. You've got Yemen. I think you've got another site in Sudan. So that area geographically for the US is quite strategic. The airport itself, in terms of once it's finished, Stephen, they expect to ferry about 100 million passengers by 2029 and 4 million tons of cargo. But the reason why this is a bit more exciting for me, Stephen, is that two big players are playing in Ethiopia, and Abiy Ahmed has actually played it quite smart. And I'm putting on my African capitalist hat, which I'm always excited to put on. First thing is that you said America is investing. Last time we talked about Boeing moving its headquarters from South Africa to Ethiopia. We talked about GERD, the big Africa Renaissance Dam, and how America is now siding with Ethiopia. So they're making all these power moves, investing and supporting Ethiopia. But China is also investing in Ethiopia through the Belt Road Initiative. So Ethiopia, in a way, is realizing these guys want to invest and capitalize on our economy, but they're forcing them to make significant strategic investments. Ironically, China is still the bigger player in terms of investment. I think there are about 4,500 companies from China in Ethiopia. So it's become a competitive landscape, but it's almost becoming a win-win. And I think the question is, can Abiy Ahmed maintain this and still contribute positive reform to Ethiopia in the long term? If this happens and it becomes a little Singapore or maybe a big Singapore, that'll be a great thing.
Or even in Dubai, in terms of the airport.
Dubai in terms of airport. Just to give you an indication, Stephen, Ethiopia Airline is making about $7.5 billion turnover, and it's profitable. So, and I think ideally once this airport is up, they'll be able to do direct flights from Ethiopia all the way to North America. And it'll be quite strategic all around.
Ghana, we've been talking about airports. They're looking at a port, $1 billion. This is around the control of the Sahel.
Again, so it's both Ghana and with their Tema port, as well as the Cote d'Ivoire. With their Abidjan port. Now, why are these ports quite strategic? Obviously, these two countries are neighbors. They are competitively positioning their ports and putting massive investments because it's a gateway to the Sahel region. And the Sahel region being Mali, Burkina Faso, and Niger, the naughty boys are putting inverted commas. But there's a lot of commodities moving up and down there. So just to give you some stats, Stephen, if you look at the Ghana Tema port, it's estimated per annum they have about 8.6 million tons of goods that they received, and there are about 1,650 ships that go back and forth. Compare that to Abidjan, they've got about 35 million tons that go through per annum, and about 1.6 million TEUs. So to cut a long story short, both countries are strategically located. They've got great quantities and commodities going through. And the positive things, they're competitively positioning themselves as ports on the Atlantic, but at the same time going to Africa. The only sort of concern I've got, Senegal is doing a major investment with DP World in terms of a port, which is probably going to be the biggest port in Africa. So the question is there going to be an oversight? So it'll be interesting to see how that turns on.
Everyone's talking about copper at the moment. Oh, it'll power AI, it'll power this, it'll power that. I mean, look, we've heard this before, but Angola's first copper mine, production next week.
Yeah, first copper mine, obviously want to diversify from oil and gas. So their first copper mine is in one of the key cities. Copper, as we know, Stephen, is a transition metal. So it's going to be, it's a transition mineral. So it's going to be quite key with regards to the investment there from a global perspective. And they're partnering with China. So that's another positive sense. And Anglo and Ivanhoe invested in there. So it'll be good to see how that story turns out.
And then Sudanese clubs are going to play league football in Rwanda. I mean, it's Africa's, like, I think, biggest country by geography and one of its smallest.
So the positive side in all of this, I mean, Sudan's still going through a civil war, so we know that sad story. But I think Nelson Mandela highlighted the importance of sport just in terms of bringing another sense of peace and hope for people. And two Sudanese PSL teams are playing in Rwanda in their Premier League, which is great. They played in the Mauritania League last time, but it just gives an opportunity and hope for young people, whether men or women, to be able to participate in sports, which just takes away the stress and the frustrations with regards to operating in terms of the civil strife that's going in the country. So it's a nice story to have, just in terms of seeing how sport brings another different kind of story in a region that is facing a lot of turmoil, Stephen.
Rotundo and Dingley, thanks very much indeed. You've got 10 seconds to say how's it to Aubrey.
Aubrey, how are you, man? Thank you for punishing me on you. I survived.
We were gossiping about him on the show.
I didn't say we're gossiping. I said we're having an ideological conversation with regards to the Stephen Grootes show. That's how you talk with the Aubrey.
To you and me, it's gossip.
The Money Show.
Personal Finance with Warren Ingram.
Warren, good evening. Tonight we're talking about buy now, pay later. We were talking about second-hand cars earlier. Somehow it all seems very appropriate. Warren, how's it going?
Good, thank you, Stephen. And it's great to be chatting to you when we're now not grey listed. It's a little bit of good news we should all celebrate.
Indeed, yes. So I think the main thing that you see that's pay now and pay later is often furniture shops. And they seem like a good idea. Sometimes they're not charging you interest. Sometimes there's a payment holiday at the beginning. Why is there such a big catch? I mean, how do you see the whole idea of buy now and pay later?
I mean, it's ironic. The thing that inspired me to do this was actually my wife and I buying kind of a little cushion that you put your feet on, and it's for our dog to kind of get up because she's old now. And on the back of the price tag, it said you can pay for this over 6 months. And that struck me. And I asked the cashier, I'm not going to name the shop, but I said to the cashier, do lots of people do this? And the cashier said, yes, absolutely. And it wasn't an expensive item. Me, I'm a cheapskate. But I just thought to myself, I wonder, what's going on here? Because it's a smallish cost item, and they're giving me 6 months and no interest and on the surface, no fees. But actually, when you start to dig into this, what really happens is you think it's affordable, especially if it is a bit of a bigger item. Let's say it's a couch or whatever the deal is, and you decide, well, I can't afford whatever it is, 10,000 rand, but 10,000 rand interest free over 6 months. Suddenly, that's not so expensive. That's not even 2,000 rand a month. I can afford that. Let me do it. And so you go, and it feels like a fairly painless, fairly sensible thing to do. You keep your cash, you only pay out exactly what they're asking for, and you earn the interest on your money while they're almost funding you. But actually, the catch to me is a couple of things. One, that buy now, pay later price is rather higher than what you would pay at a retailer that doesn't offer that. So that's the first thing. Is I think generally the item itself is not more expensive if you did buy now, pay later at the same place. If you said, I'm going to buy this chair with cash, or I'm going to buy it and pay over 6 months, the price would be the same. But the retailers that offer this tend to be a bit more expensive. So firstly, I think the items themselves are a bit higher in price, and then secondly, yes, it's interest-free. Yes, there are no costs if you stick to the terms. But miss one payment, and all of a sudden you start to realize the catch. And the catch is they start the interest on day one. So from, let's say your 6 month deal, you missed a payment on month 4. They start to levy interest on day one of the first payment that you owed, and then all of a sudden there are fees. They start to charge you admin fees for doing this, and so before you know it, the item that could have cost you $1,000 is suddenly costing you $2,000 because of all the fees and the interest that they're now charging you. And I think that's the deal.
Yeah, sorry, I'm going to come back to some of that detail because some of this is very important, but I just want to get one other fundamental thing out the way. Sorry to interrupt you, Warren, is that one of the things about buying something like that without having to pay immediately is you don't feel the pain of it. You don't see the money leaving your account. And I've often thought that must be such a big part of this, is that you're going home with this item, cushion, shoes, whatever it is, furniture. It's changing your life in some way, and it's cost you nothing. And isn't that psychological part of it such a big thing?
Yeah, it's cost you 1/6 of the item's price, and so it's a little bit like the car dealers. When you go and you say to a car dealer, I want to buy this car, but it's too expensive. And the next question is, well, what can you afford to pay on a monthly basis? And let's say the car payment was, meant to be 20,000 Rand a month if you paid the car off over, 5 years with no residuals and all those things. Then the car dealer comes back to you and says, don't worry, if you can only afford 10,000, what we can do is we can work a deal where you can pay the 10,000 a month, and at the end of 6 years, you have a residual of 40% of the car value. So and I think the same psychology applies here. You start to divide the cost of the item by 6, and anything divided by 6 suddenly seems a lot more palatable, and so the sales process and the psychology behind the sales process is very attractive.
When you buy something on buy now, pay later, the retailers are often very keen on it. And does that mean they get a fee somehow? Do they benefit if you do it that way rather than the normal way?
Yeah, so sometimes they've got an in-house finance department. So if you look at some of these retailers, I often think they when you look at the stock exchange listings, some of these retailers should not be listed as retailers. They should actually be listed as financial institutions, because they make so much money from financing and from lending and all the financial services that they offer, and actually comparatively a bit less on the retail. And I feel that's what's going on here. So they might have their internal finance department, and it's very lucrative for them to do this, because the second you miss a payment, it's almost like you're in a microloan process now. There's going to be lots of admin fees, and I can promise you those admin fees are not reflective of the actual cost of what's involved. These are punitive fees that they're making money out of the fees, and they're making money out of the interest. Sometimes the retailer doesn't have an in-house finance department, and what it does then is it brings in an outsider, and you'll often see these at retailers. And every time the retailer then signs a deal where there's now this buy now, pay later scheme, they're getting a fee, and it's not a hidden thing. It's not a kickback. It's all disclosed and transparent if you go and read the 12 pages of fine print, but it's there. And now they've made money from selling you the item, and they're making some money from the finance charges. So certainly, Stephen, what a great way to make money twice on selling the same item.
And then if you miss one payment, you can suddenly be charged a fee immediately. So that's not interest. That's something else?
Exactly. So now it will be called an administration fee. It'll be kind of worded more gently than penalty, because that just sounds terrible. So it'll be, oh dear, you've missed a payment. I'm terribly sorry. We're going to have to charge you an admin fee, because now there's admin involved. And the fact that, might not be much admin doesn't stop them from charging the fee. So now you're paying an admin fee. On top of that, you're going to start paying an interest payment as well. And so that's when the costs start to rack up against you very quickly.
And the admin fee, I just want to get to the bottom of this, because this is all computerized, right? There's no one who now has to fill in 3 forms, and you have to pay that person to fill in 3 forms. It seems to me just a way to make money.
Yeah, I think it's a very lucrative way of dealing with this, and I think the argument in defence will be that this is all disclosed to you. You agreed to a deal with us, and you agreed to pay us a fixed amount for 6 months, and you've taken the item home, and so now there's work involved for us as the retailer. Because you haven't stuck to your side of the agreement, and we're entitled to charge you a fee because, we have to do a huge amount of work by pushing 2 or 3 buttons.
Okay. All right. So actually very quickly, something that cost you 1,000 Rand can go up to 2,000 Rand. You miss one payment, there's a fee. They charge interest from a very early stage on that. It's actually quite easy to get into trouble here.
Yeah. And I think it's... it's a bit like the credit card problem. When you get your first credit card and you start to swipe and swipe and swipe, it just feels like everything's fine until the day you reach your credit limit, and all you can do is fund the absolute limited, the minimum payment possible. Very quickly, you start to drain your cash resources. So I feel like this is the credit card problem in reverse. You're getting the item up front, you're committing to, a bigger cost, but it's being spread out over a period of time. And, truthfully, if you did stick to the deal and you paid everything off and you carried on, then perhaps the only downside is that you might have paid for a slightly more expensive item than that you could have got somewhere else at a cash-only retailer, as an example.
Okay, and then the juggling act starts, and this, I presume, is when you don't have just one item on buy now, pay later, you use it for everything.
Yeah, I think that's the thing where I think we're going to get caught out. A lot of us, if you're not, really on top of this. I mean, I think as a starting point, there are very few people that would do the buy now, pay later if they have the cash resources to buy the items. They don't want to go through the hassle of all the paperwork, etc. So most of the time, you'll just swipe on your credit card if you've got the capital available, on your debit card, whatever it is, and you would move on. If you're doing this, it's because you are in one form or another cash constrained. So now you're buying an item that actually you can't afford. And so you give yourself a little bit of breathing room from a cash flow point of view in a month. But this becomes a bit addictive, right? Because now you think, well, I've bought the chair, but now I need the cushions and the throw and all the other things to decorate. So let me go back and buy all those things as well on buy now and pay later. And I think that's where you start to get caught out. And I have seen some studies around this behavior, because this is not a South African thing. This is a global thing. And it seems like people who participate in this kind of buy now, pay later behavior end up spending somewhere around 20 to 30% more than they normally would if they just had cash. So, we were talking about, it feels affordable. It feels like something you can deal with because the cash flow is being spread out over a period of time. Now you add up, multiples of these all at the same time, and somewhere along the line, the merry-go-round stops and things start to fall off and you get yourself into trouble.
Are there any moments, Warren, when you would use buy now, pay later? I mean, is it a blanket no, never? Warren said no. Or do you think there are moments when actually, are there emergencies? And I know, obviously, we're supposed to have an emergency fund, but are there moments when actually maybe you would need to do it?
Yeah, I think it's exactly that. It's for the thing that is a real emergency. And I try to think of, a really good example, because I don't want to be the Grinch that stole Christmas and say you should never do this. But my instinct when you're asking the question is to say, no, Stephen, there's never a good time. But the truth is, if if you work and you earn an income from your laptop, or you earn an income from your smartphone, and those aren't insured, and something goes wrong, and you don't have an emergency fund, the reality is you could lose your job if you don't replace those items. And so I would guess, if you don't have the cash to buy, the quality smartphone that you need, and I really mean need for work, not need to stay connected to your friends, or a laptop because that's how you make your living, then I would guess something like that does really qualify as an emergency, and so maybe that's the kind of situation I can think where you would do this, but it's not. And I mean, really not, I desperately need those shoes for the party on Saturday night, or, I want to do up my house nicely because I want a housewarming, or anything that I would call discretionary, something where you could live without it and life wouldn't be worse, except maybe you feel a bit embarrassed about something. That's not an emergency, not being able to generate an income because you don't have a laptop. To me, that's an emergency.
All right. We have a question for Warren tonight. The question comes from Paul. Hi, Stephen. What is the impact on my investments of South Africa being removed from the grey list? Does it actually mean anything for me? That's a great question. If you've got questions as well for Warren, 011-883-0702, 0214460567, and of course voice notes tonight on 072-702-1702. It's 11 minutes to 8.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud sponsor of the Absa Africa Financial Markets Index 2025.
The Money Show.
Personal Finance with Warren Ingram.
Warren, of course, is the co-founder of Galileo Capital. And the question from Paul for you, Warren, was, what is the impact on my investments of South Africa being removed from the grey list? Does it actually mean anything for me? And I'm sure Paul's not alone when he asks that.
Yeah, I think maybe start with the bad news, then the good news. So the bad news is we would have all noticed that the paperwork we required to do for our anything to do with a financial institution, whether it's for investments or banking or credit or anything, the paperwork has got a lot more in depth and a lot more painful since we were put on the grey list. And that's because, the FATCA, which is the kind of global body that looks at this money laundering stuff, said that, we weren't doing our homework properly as a country. We weren't monitoring money laundering and anti-terrorist financing and all those things. And so we had to step up our game. And now being removed from the grey list doesn't mean that that kind of extra due diligence will go away. I think it remains, and anybody who is involved in a trust or an investment company will know that the documentation required for those kinds of legal entities is now very extensive and very painful to collate, and I don't think that's going away. If anything, it will probably get a little bit tighter and a little bit worse over time, because we want to prove to these authorities that we're going to carry on with this work. So that's the bad news. I guess the positive of that is somewhere along the line, it should start to catch out all the corrupt crooks, and they should be found out in a process like this as well. But for the rest of us ordinary citizens who just want to get by and do our thing, the good news is that, especially on international investments, it should become a lot easier to invest our money overseas. Anybody that's tried to buy, especially euro-listed investments would have found that it's probably been a lot more painful, a lot more difficult, to buy those investments, things like exchange traded funds and unit trusts, since we were grey listed. And some of the Euro banks have just flatly refused to deal with South African sourced money, because they said, we're on the grey list. That means you're high risk. You're required to do enhanced due diligence, and we're not going to do that. We'll just not deal with you. So I would think over the next probably month to 2 months, I don't think it'll happen next week as an example, but over the next month to 2 months, as more and more banks, update their systems, they'll realize we're on the good list, we're not on the naughty list, and the enhanced due diligence for transactions will go down. So, we'll still be required to do lots of FICA and lots of, proof of address and all those things, but certainly it should become a bit easier to do transactions. And then I think for businesses that are involved in the world of import and export and those kinds of things, their lives again will be a lot easier now, and probably a lot less less frustration and possibly cost as well. So yes, Paul, I think it's good news. I think your life does get a bit better, but maybe not in the next week or two.
We actually have a voice note for you on the subject we've been talking about buy now and pay later, coming through for you tonight, Warren.
Good evening, Stephen. Stephen, the other thing that they do to get us, especially the young ones, with the whole credit card thing and account thing, is because when you want to buy either a vehicle or a house, an asset, things that you know that, okay, these I absolutely need, and you don't have a credit record, they tell you to go get those very same things. But that time you're thinking, but all I want is a car, or all I want is a house. Now you are making me go get a credit card or a clothing account on a buy now, pay later method, and I don't need those things. And they say, go build up your record. We don't know how you pay, so go somewhere else before you come to us.
Such an interesting point. I mean, there's almost this incentive to get involved in this, isn't there, Warren?
It's such an irony that the people that that are fiscally disciplined, that maybe only need to borrow for very big items, are the ones who might end up being punished for the very good discipline that they have. And I think it's a very valid point. So, I always think when you are young and you're starting out, and you do need to build up some kind of a track record. And unfortunately, the system does work like that. They do want to see a history of discipline around the way you pay accounts, etc. You can always apply for a credit card. You don't need to take the credit that the bank is offering you. So, for example, if the bank says, well, on your salary, on your first job, you can afford, credit limit of 30,000 Rand. What you can say to the bank is, I don't want 30,000 Rand. Give me a credit limit of 5,000 Rand. And then, you use that for a little bit every month. And let's say you use 1,000 of the credit limit, and then make sure you pay it off, with discipline ahead of time. And so you will build up a very good track record on your credit score and all of that, but never getting into the big trap where you find yourself, with a huge debt hole because you got caught out.
Okay, yeah, that's interesting. If you're very tempted to use buy now, pay later, Warren, what can you do as an alternative?
I think this is a little bit of self-management. So I love this 24-hour rule, and if you see something in a place that that offers this buy now, pay later, and you are very tempted because you absolutely need that new chair or that new couch or whatever it is, my suggestion is write down the price, take a photo, and then go home, think about it, sleep on it especially, and maybe talk to one or two friends, especially those that are not buying enablers, not the people that always tell you to buy stuff. Speak to the more sensible people that and discuss it with them. And if you still feel very strongly that you want that item, then the next thing is you've got to say, okay, I'll buy it, but only if I can afford to pay for it with cash. None of this buy now, pay later nonsense. If I can't afford to buy it with cash, then what I'm going to do is I'm going to save up and put aside some money every month and keep going. And at some point I'll have enough cash, and then I'll go and buy the item. What I find is doing that with myself, all I need to do is go home and talk to my wife, and she'll say, we don't need it. There's nothing wrong with the thing we've got, whether it's the TV or the couch or whatever it is. And so that urge passes very quickly. And if you're the same, then that's the deal. But if not, then the discipline of saving for it and giving yourself a goal means that you might take 6 months to get it, but you're doing it with cash without the danger of getting caught in a trap like this.
Warren Ingram, thank you very much indeed. Very wise words. Really appreciate it. The co-founder of Galileo Capital with personal finance on The Money Show this evening. So often, whenever you're thinking of buying something, that idea of a cooling off period, just 24 hours, such a good idea on almost everything that you do, actually, particularly for the big decisions. Warren, thank you.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud sponsor of the Absa Africa Financial Markets Index 2025.
Well, still, of course, markets waiting to see what happens later in the week when the U.S. President Donald Trump meets the Chinese President Xi Jinping. And, of course, also Apple going past $4 trillion in valuation today. The Dow Jones up 0.2%, the Nasdaq up 0.71%, the S&P 500 up just 0.25% at the moment. We're back tomorrow. Good evening. It's 8 o'clock.